Hey everybody, it's Pete. Thank you so much for joining me today. Today's episode of Stocks for Breakfast is going to be a little bit different. It's kind of an advanced lesson in stock trading, but it's really something that is critical to understand why sometimes it feels like as soon as you put a trade on, especially a swing trade, that as soon as you put it on, it's a losing trade. You're like, oh my gosh, it's me. I'm the only one who puts on a losing trade as soon as I do it, and it starts to mess with your mind a little bit, and you start to feel like you don't know what you're doing. You start to doubt your ability as a trader. And what I want to get across is you're probably doing enough work to find good ideas. But what we want to talk about today is something known as the bullish echo. It's a term that I've coined to really understand when to be buying at the right time, but more importantly, how to manage the trade expectation at the right time when you're in a stock that is obvious but you're not making money in it, or you picked the right stock and you got involved and maybe it moved in your favor quickly, which is what we're going to actually talk about today, and whether or not that should have been in your mind a trade to hold a little bit longer, or the expectation should have been, all right, it's a little bit played out right now. I can still take advantage of this right now for some cash flow, but it's not something I want to commit more capital to, or more importantly, more time, because it's already played out. So I guess what I want to get across here is, we talk about this and everybody understands risk reward, right? Everybody understands that, the cliched numbers, and they're cliche because they work, is I want to risk one to make three. So we can have that in our mind and think, okay, I'm going to risk one to make three. How much do I need to accept as risk on this trade? And what are the odds of me making a minimum of three? Now, I want to mention this very briefly, quickly, and succinctly, right? Oh, by the way, if you find these videos helpful, definitely click down and subscribe to the channel to get updates. I have a lot more new educational stuff coming out. I would really appreciate it, and you'll get updates too. So when we talk about 3-to-1 risk reward, what's important to understand is if you choose to accept that risk, and let's just say it's 1, and when you put that trade on, it looks like 3 is there, and that's good, right? So the first part we need to get across is getting the 3 is not the only target, but it's certainly the minimum profit target to accept the risk. So if we can get that across where the math just works out, and what's exciting about this is if you're taking trades that have that 3-to-1 built into it, and you understand that's the minimum, and when it gets up to that level, then you kick in with different strategies for trailing stop losses, which is the best, most fun conversations to have, which we're having a lot of those in the boot camp right now, is how do I manage this winning trade? How do I manage this winning trade? So in other words, you accepted the risk, got up to 3, and now you're like, okay, which trailing stop loss strategy is the correct one for this position? But talking about the bullish echo, now we've established 3-to-1, we've established that's the minimum target, we established you move up your trailing stop to see if you can keep squeezing more and more out of it. The challenge comes in when the stock has now given or already performed what might be from the optimal entry, where that 1 is super obvious and easy to accept in exchange for the 3 or more. What happens when you miss the optimal entry, but the stock is still obvious, and the stock is still obvious, but you know in your heart of hearts that if you buy it now, you're late, but you can see the stock going up today. So like you're stuck. You're like, what do I do? Here's the thing, and if you could think of bullish echo and keep that terminology, it essentially means a stock that's strong, a stock that's exhibited momentum recently. We call that well bid in the boot camp, but you know that the odds of it turning around soon are pretty good. So it doesn't have that same 3-to-1 anymore. It might have the same target, it might have the same obvious side, but getting involved in that trade right now, you just know it's still a good idea, but it's probably too late. But here's the thing. We said too late, not over. So what happens is you get these trades that go up one day, they go up another, you have the optimal entry, they go up, they go up, they go up, they go up. And you're like, I want to get involved with this. It's so obvious, right? We had this in DDD this week and GME and a few other stocks as well. But here's where we make the distinction. And we talk about this quite a bit in our morning game plan meetings. The difference between the stock is a good idea versus whether it's a good idea now for a new swing trade. But that doesn't mean you still can't make money on the trade. As long as you go in recognizing 1 was here and 3 was here, as it starts to move up here, there's still a little bit of meat on that bone. Like it's kind of like the after dinner drink, right? Or the after, whatever you have after the after dinner dessert. There's still a little more, but it's not as big as the bigger portion of accepting the risk, right? So I'm going to show a couple of examples here where today we've been looking for a bullish echo. We're looking for the next one-day move, maybe two, but definitely something that we can day trade for some cash flow, but we're not looking to initiate a new swing trade on super obvious stocks. So again, if you could think of this, think about the amount of opportunities that you've taken where it was obvious, but you lost money right away, or obvious where you put the trade on, gave it a little bit more room than you probably should have, and it pulled back on you. And then 2 weeks later or a week later, it did exactly what you thought. It's because you're initiating a longer term swing trade during the bullish echo, as opposed to just trading that for cash flow, waiting for a pause, and then initiating a new swing trade. It's a lot, but you'll understand it in a second. I keep doing this because it's something that's quick to visualize. And when you see it, you'll be like, aha, I was swing trading the bullish echo instead of cash flow, waiting for the next move. I'm going to show you what I mean right now, because there's a couple of really obvious trades that we're looking for as a bullish echo today. So one of them right here is Wayfair. So you can see clearly Wayfair is past the obvious entry, past the optimal target, but still clearly obvious in the most recent price action. But we wouldn't be looking to initiate a new longer term trade as we, looking at support and looking at the thing rally because of how far it's already gone. So the odds of a new swing trade are diminished, but it still clearly has recent bullish order flow. So today we'd be looking for a bullish echo in this stock. What was another one? SFIX was another one. So you can see clearly the optimal entry was here. We've been discussing this one. We actually called that one out earlier in the week. Hopefully you participated in that one. But now it's too late to initiate a new longer term trade just based on what the stock normally does when it has a bullish move. So the 3-to-1 isn't there anymore, but maybe there's still one. So you're not risking all the way down there anymore. You're just actively trading it on a shorter time frame. So when you spot these trades that are clearly moving in the right direction that you want them to trade, which in this case is as a buyer, right? Clearly has obvious order flow, but is also clearly late. You can take advantage of it, but when you're trading the bullish echo, it's not a longer term trade. You're not giving it as much time, because if you think about it, the echo dies right away, right? You hear it, but it's gone. So that's what we're looking to do here. So in this case here, we'd probably be lowering share size a little bit, probably have a little bit more of a game plan to be booking profits into momentum, as opposed to when it pushes up and pauses, we're not looking to add, we're looking to get out. So if you could spot some of these ideas that have obvious, what we call well-bid candlesticks, higher highs and higher lows, but you missed that optimal entry, see if you could adjust your trade management to compensate for the bullish echo. I think you'll be surprised at some of the shorter-term cash flow trades that you could make without having that same downside, without starting to doubt your confidence, because you're like, I found a good idea. Went in my favor quickly, but then quickly reversed. That's because you should have been trading the bullish echo as opposed to looking for longer. So remember, the echo dies out right away, but you do hear it. So let's start to pay attention to those ideas in the game plan. And you'll be surprised that when you just shift your mindset a little bit, because it's the right idea, but not the perfect time, you can still capitalize, but not in the same way. Okay, if you have any questions about this or examples, leave a comment below below the video, and I'd love to hear from you about it. Okay, have a great day, everyone.